Hello friends, welcome to the Manthan series of BFM. In Manthan series, we are covering all the subjects. Numericals, objective questions, case studies, everything is covered. So follow the series completely. All the mentors, follow them. We are covering the recollected questions. Today, I will be covering risk regulations in banking industry. Subscribe to the channel, click on the bell icon. Okay. Most difficult chapter in your BFM, most difficult. It's in module B and most difficult chapter. So follow the video completely. Which of the following is a potential internal factor that may lead to liquidity problems in the bank? Say internal factor which may lead to liquidity crisis. Liquidity crisis means not having sufficient money. So which will result? Look at this, the words internal factor, external economic shocks. See, this is related to market risk. Okay, first let me get the answer from you. Decreasing depositors' trust, very sensitive financial markets, non-economic factors. Let me see the answer from your side first. It is? Yes? What is the answer for this? See, the answer is this. Why? Because this is market risk, market. This is market risk, sensitive financial market risk. These are not in your hands, not economic factors, non-economic factors. Okay, these are market risks. Only this is the internal factor. Okay. Next, which of the following statement is not correct regarding floating provisions? Not correct regarding floating provisions. So not correct. These provisions can be netted off from gross NPA to arrive at the disclosure of net NPA. Now first get me the answer. You give the answer, then I'll give it. These provisions can be treated as a part of Tier 2 capital within the overall ceiling of 1.25% of RWA. These provisions can be reversed to the credit to P&L account at the discretion of the banks. So which one is not correct? Let me see the answer from your side first. Answer from your side. Yeah. See, these provisions can be netted off. What is the meaning of provision? Provision means basically gross NPA minus net NPA. Isn't it? Provision is gross NPA minus net NPA. So A seems to be correct. Netted off from gross NPA to arrive at a net NPA. So this is true. But you want false. Second one. These provisions can be treated as a part of Tier 2 capital. That's right. Because Tier 2 means what? It's a paid capital, gone concern. Within that limit of 1.25%. So this is also right. So this is true. Now you want this false. So this is false. Not at the discretion of the banks. You can't, at the whims and fancies of yours, not allowed. There are rules and regulations. So this can be reversed only when your loan account, your NPA is recovered either or it is sold under that securitization. Only then it can be reversed. Okay. So this is the right answer. A doubtful for more than 2 years account has balance of 7 lakhs with a security of 5 lakhs. The account has CGTMSE guarantee of 75%. What is the amount of provision? See, very simple. It is doubtful for 2 years, more than 2 years. So it is basically D2. D1 is up to 1 year. From 1 year to 3 years is D2, right? D2 has a 2 years period. So this will be in D2. D2, what is the provision for D2? D2 equals to 40% for secured and 100% for unsecured. Okay. Now 40% for secured. Secured is what? 5 lakhs. So 5 lakhs, 40%. Multiply this. 5 lakhs into 40%, 2 lakhs. So the provision is 2 lakhs over here. Provision. You want to provision, right? So provision is 2 lakhs. This provision is 2 lakhs over here. Now for this remaining unsecured part. What is the unsecured part remaining? 2 lakhs. In 2 lakhs, you have a CGTMSE guarantee that is of 75%. So 2 lakhs into 75%. So that is 1.5 lakhs. Okay. So this much is secured. by the insurance. So what is unsecured now? 50,000. So 50K, right? 2 lakhs minus 1.5 lakhs, 50K. So your total provision becomes 2.5 lakhs. That is the answer. Okay. Next. Read it? What is the answer? Here, I'll read it. The credit risk assessment exercise should be repeated biannually, annually, once in 3 years, none of the above. So credit risk exercise should be repeated how many times? Means, should I repeat for all? See, what do you mean by credit risk exercise? Checking all the loans, their collaterals, their risks, their issuer risks in bonds, checking the issuer's risk ratings. That is checked over here. So it should be repeated how many times? Is it biannually? Means once in 2 years. Biannually means what? Once in 2 years. Is it so? Or is it annually, once in a year? Or is it once in 3 years? It's obviously 3 years over here. So what is the answer? Biannually, annually, or once in 3 years? Or none of the above? That can also be the answer, none of the above. Yeah. What is the answer? It is annually. Every year you have to do it, every year, because that's what you are paid for. I'm in the bank because I have to do this credit market ops risk analysis every year. That's what I'm paid for. If I don't do it, then out, ghar, chalo ghar. Isn't it? Now banks are very professional in your life. Kindly note, banks have become very professional. Let it be nationalized bank, let it be private bank. Either you perform or you perish. Perish means out, perform or perish. This is a new term in banking. Perform or perish. Bank wants knowledgeable workers. Knowledge workers they call it. Bank wants that. Perform or perish. You either give the performance or you are chalo, bahar. Okay? Which of the following statements about the credit spreads are correct? Credit spread. Now credit spread means it is related to credit risk, but basically it means what? It means NII. Net interest income. Which of the following is true regarding this NII? The pricing of the credit is done on cost plus approach. That is benchmark rate plus spread. So pricing of the credit is done on cost plus approach. What is cost plus approach? Cost plus means we decide a benchmark first. Now what is the benchmark? Let's decide. Let's look at it. What is the benchmarks here? There are two benchmarks. Okay, two benchmarks. Which are those? One is external EBLR, external benchmark lending rates, EBLR. EBLR, external benchmark lending rate. Second is IBLR, internal. IBLR. What is this? EBLR. EBLR has two benchmarks. Okay, EBLR has two benchmarks. Type it. Who knows it? EBLR has two benchmarks. Which are the two benchmarks of EBLR, external? Let's count 20 now. It's a difficult question. 1, 2, 3. I'll count. You give the answer. 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. What is the answer? Comments, everyone. Here I come. Okay. So it is EBLR. EBLR is of two types. FBIL, Financial Benchmark India Private Limited. It's PL, FBIL, PL it should be, but we call it FBIL. FBIL, PL it is. Financial Benchmark India Private Limited. It's a company which gives the benchmarks. These benchmarks, this company is owned by RBI, totally owned by RBI, 100% owned by RBI. So RBI owns this. So one, this company gives the benchmark. Second, RBI itself gives the benchmark, RBI. RBI gives the repo rate, right? Repo. RBI gives the repo rate. So these are the external benchmarks. Okay. One is this FBIL, and second is this RBI. Okay. FBIL, kindly note, this question comes in exam. FBIPL actually. FBIPL, Foreign Benchmark, Financial Benchmark India Private Limited. So these are the two benchmarks, FBIL rate and RBI rate. More on this later in module C you are having it. So internal benchmark. Internal benchmark is nowadays mainly related to MCLR. MCLR. Okay, it is related to MCLR. Marginal cost of lending rates. What is this? You have heard? You have heard about this MCLR? How many of you have heard about this in the banks? MCLR? Give me the answer, chalo, in comment section. What are the components of MCLR? Fast. Jaldi, jaldi, jaldi. Jaldi. Yes? You know that Donald Trump's dance? Yes. Jaldi. I always remember this dance. This guy has changed the whole world, right? What a majority he got. This was his dance, no? This. Donald Trump dance. It has become very famous, huh? So MCLR, what are the components of MCLR? The components of MCLR are here, very simple. MNOP. MNOP. ABCD, you know? ABCD, EFG, HIJK, LMNOP. LMNOP. M is marginal cost. Marginal cost. Now I won't write a full thing now. Marginal cost. N is negative carry on CRR. Negative carry on CRR means where I don't earn any interest. When I invest in CRR, do I get any interest? Do I get any interest when I invest in CRR? No interest. Okay? So I don't get any interest in this. So that is negative carry. O is operating cost. Operating cost means your all salaries. You all are working now in bank. Operating cost. So operating cost. Okay, salaries, all your salaries. And P is tenor premium. This is very important. Tenor premium. Tenor premium. Remember this. Tenor premium. Very important part about tenor premium. It is the tenor premium is related to loans which are tenor premium is related to loans which are of long-term duration. The loan should be of long-term duration. If I give the loan of 3 years, 4 years, no tenor premium, nothing. If I give the loan for 10 years, tenor premium. More than 10 years, you'll say, sir, we can't give more than 10 years. What are you saying? I agree you can't give. But if you take the special permission, you can give. Special permission, with special permission you can do anything. And why not? Why not? If I have to build a dam, good dam is to be built. This road construction right now going on, NHAI, whole highways like butter, right? Isn't it a development? So banks can give here. Normally you can't give. 10 years is the maximum limit. But if you take special permissions, then these are allowed. So coming back to this point, when you give the loans of the higher tenure, in that case you have this MNOP, tenor premium. So coming back to this point, pure year, cost plus. So this, see this, just one word, so much description came into it. Yeah, point is not answering. Only answering is not the question. This question may not come in the exam or may come in the exam. Anything is possible. You must know the basics. You got this point over here, EBLR, FBIL, REP, RBI, IBLR, MCLR, MNOP. This you'll remember it throughout your life. Now the question can come on this also, can come on this also, can come on any of these also. Anything the question can come. So in one question we have covered so many topics. This is what is required. Because nobody can guarantee I am taking 10 questions. Will these 10 questions come? I don't know. But the explanation in that will be definitely useful to you. Okay? So where were we? Pricing cost plus benchmark plus spread. The spread comprises various factors that include product specific operating cost, credit risk premium. So it obviously is the spread comprises product specific operating cost, means whatever here MCLR is generally taken for product level. Many times each product has different MCLR. Many times each product, home loan has different MCLR, then a personal loan has different MCLR. Many times this can happen. So product specific, and this spread is also decided on the product. What is the risk level? It's decided on that. Next, business strategy is component of spread under MCLR system. So business strategy is component of spread under MCLR system. So that is also correct. Okay, component of spread. What is the spread you are taking? So all 1 and 2 and 3 are correct. But what about 4? Let's see the fourth one. The spread component can be negative in MCLR. The spread component can be, let me remove this all. Now you have got it, everyone. The spread component can be negative in MCLR. This is false. This can never be true. This is false. Can you give the loan like this? Repo minus 2. Can you give the loan like this? Or MCLR minus 2. Can you give it like this? Not at all possible. Right? It's not possible. So you have to give the loan this. If you want to give it minus 2, then why not to reduce this MCLR by 2? If my MCLR is let's say 8% and I'm giving 8 minus 2, 6. So reduce that MCLR to 6. It's that simple, isn't it? So this is not possible. So the answer is only 1, 2 and 3. B is the answer. Okay, got it? Dash applies to any financial instrument that are denominated in currency other than your own. Currency other than your own. Okay, I'll add one more option in this. A, B and D. Look at this, one more option I have added. So dash applies to any financial instrument that are denoted in the currency other than your own. Means I am having in rupees. So I purchase a bond which is in dollars. So which all risk will apply to this? In that case, see, this country risk will apply because dollar is a currency of USA. Credit risk will apply. If tomorrow something happens to USA, then what? I'm in trouble because I've purchased the bonds. Nobody will pay me. Of course, very less chance. But after all, risk is a risk. Reinvestment risk, forget it. This is not a part. Reinvestment risk is different. Means, what is reinvestment risk? If I purchase a bond right now, after 3 years, if I want to repurchase it, means maturity, then repurchase. Then will I get the same rate? So that is out. Okay. So that is not related to this, any of these risks right now. Concerned with this. Foreign exchange risk, obviously it's there. Suppose if the dollar rate tomorrow comes down, goes up, obviously my value will be affected. So what is the answer in this then? How many of you got this answer right? Let me see. How many of you got this answer right? Let me see in the comment section. Yes. The answer is E, A, B and D. A, B and D. This is the answer. All the 3 risks are involved in this. Okay. The credit risk of bank's portfolio depends on which of the following factors? So credit risk depends on which of the factors? State of the economy, trade restrictions, inadequately defined lending limits for loan officers and credit committees. Inadequately. Now check this. You have to answer this. You have to answer. Very simple one. I have already discussed pastel. So now answer this. Yes? What is the answer? Yes, comment section. It is all the three. Okay, all of the three, A, B and C. Okay, because pastel, state of the economy, trade restrictions, political, P. State of the economy, E, PE. And this is internal. This is not related to pastel. This is internal. You don't fix the limits. Who is to give what loan? You don't know. Branch manager has what powers to sanction? You don't know. Definitely there will be chaos, right? Credit risk will definitely arise over here. Okay? The management of credit risk process should encompass which of the following? So credit risk, if I have to manage, it should encompass which of the following? Encompass means what? It should have. It should have which of the following? Measurement of risk through credit rating scoring. Measurement of risk. Should it have measurement of risk? Quantifying the risk through estimating expected loan losses. Quantifying the risk. Quantification. Quantification means finding the means what is the expected loss. We call it actually EAD, exposure at default. Okay. So quantifying. Third is risk pricing on random basis. What is random basis? Many of you got this 2 correct, right? 1 and 2 you got it correct. 1 and 2 is okay, you said. Many of you might have got, by now you might have got this A and B correct. Only C is the problem now. Many of you will say random means what? Random means very simple. What does the auditor do? Whenever he comes to the branch for the loan processes, many times what does the auditor do? He takes 10% of the loans as a sample. 10% random. If there are 500 loans in your bank, he'll take 10%, 50 loans. One this, other that, there, something like this. Any file he'll pick up. Okay, that is known as random basis. But that is not allowed. Kindly note. If you do this credit risk on random basis, then you are in the problem. You have to do it for each and every basis. Systematic basis you have to do it. Systematic. Okay? You can't do it on random basis as per your wish and will. No. Okay? So in that case, this answer is wrong. Random basis is wrong. 2 are right. So A and B is the only answer. A and B. Got it? Credit risk or default risk involves inability or unwillingness of a customer or a counterparty to meet the commitments in relation to. So credit risk or default risk, inability or unwillingness of the customer to meet the commitments in relation to. So what are the relations? Means, is it related to lending loans? Is it related to hedging? Is it related to equity prices? Is it related to both A and B? A and B means these two. Are equity prices involved in this? In credit risk? Commitment related to equity prices. So the answer is actually these two, lending and hedging, A and B. Lending means I give you the loan, you don't give it back. Hedging means again the similar. I purchase the derivatives from you, derivatives, and then you don't pay it back. Derivatives I purchase and then you don't pay me. Means I'll buy the insurance from you and then you'll say no insurance. So that's why this is, both of them are the answers. Okay. Now before going, let me show you the new batches. See, join the new batches ASAP. Go to Addar 24/7. Always purchase through the app by downloading the app. In the app, you will be getting 1% extra. So go to Addar 24/7. Click on JAIIB and CAIIB. Say this. Click on CAIIB December. Look at the batches. Mahapacks. Purchase these Mahapacks because Mahapacks are one of the best tools for you for preparation. You have still around 5 months, so you can definitely make use of this Mahapack. Purchase is increment Mahapack. In increment Mahapack, you are getting physical books as well as e-books, both. Physical books also, e-books also. So that's why purchase it immediately. Because suppose if you find a strain in your eyes, because you daily watch computers for longer period. So follow the e-book, physical books. If you are traveling somewhere, can't carry the books, follow the e-books. Both of them are there. Okay. So follow this Mahapack. And right now you are getting double validity. You buy for 6 months, you get it for 12 months. Buy for 12 months, you get it for 24 months. Plus you get 15 plus batches per subject. Per subject, 15 plus batches. Huge thing it is. Okay. So purchase this. How to purchase? Click on buy now. Put the code Y432. Y432. Enter. 80% discount plus 1% extra through the app, 81%. So 81% discount plus double validity. So it's a huge offer. Buy it now. Okay? And join the paid batches immediately.